so you had a big move with the stock market. And then it's come down real hard since 2022, just like the S&P did. The S&P turned back up and nipped out its high by about single-digit percentages. Now it's starting to give that back. Look at RWR, and it's laid in the bottom half of the price range since the drop in 2022. And right now it's nudging toward what's been a multiple bottom, even on the price charts. It looks like it's very anemic. How come it can't get going? Now, Janet Yellen just said a week or two ago, she's not too concerned about commercial real estate. It's, quote, manageable. Well, we quoted her on the weekend report because Bernanke said something almost the same in May of 2007. He says, no, the mortgage market's, it's manageable. Okay. So we have assurance from above that, no, there's no problem. When you look at the chart, there's a problem.
In today's market recap, silver price falls to 3-week low near 26.70 with eyes on Fed policy meet. Silver price tumbles to 26.70 as U.S. yields rise ahead of Fed policy. The Fed is expected to keep interest rates steady with hawkish guidance. Investors should be prepared for high volatility this week as the US Non Farm Payrolls will follow the Fed's policy. The white metal faces a sharp sell-off after breaking below the crucial support of 27. The asset faces pressure as the US Treasury yields rise amid caution ahead of the Federal Reserve's monetary policy announcement on Wednesday. The US dollar index, which tracks the US dollar's value against 6 major currencies, bounces back to 105.90. The US dollar's appeal improves ahead of a data-packed week. This week, investors will focus on the ISM manufacturing PMI and the non-farm payrolls NFP report for April, which will be published on Wednesday and Friday, respectively. Now we'll show you the best excerpts of the latest interview, but first, hit the like button, smash the subscribe button, and turn on the notifications bell so you do not miss out on our daily videos. Enjoy the episode.
Sideways with dips, just bore the heck out of you. And finally, in that October 2008 sell-off in gold, which was sympathetic with the stock market crash. By crash, what I mean is something that takes 30% off of a market in a matter of 2 weeks. Okay, that's what happened in 29, happened in 87, and in October of 2008, the S&P was already a year off of its high, had been declining for a full year, while gold had been going up, by the way, during that time. And during that, basically late August, early September, and especially October of 2008, there was this crash type event in the S&P. And sure enough, gold had a sympathetic drop, though it had been opposite the S&P for the prior year. But anyway, it did have a sympathetic drop. And it was one, when you look at the price chart of gold back then, there had been a range. It hit 1,000, backed off, hit 1,000. These are all-time new highs now. And it was July of 2008, before that drop, you hit 1,000 for a second time. And then that pullback finally sold off enough to where on a price chart, you finally took out a prior prominent low. First time in years that gold had a sell-off that actually took out a prior low. So in effect, it had a cleansing drop. As soon as it finished that drop, boom, back to the highs. Okay. Meanwhile, S&P continued down until 2009. Very similar thing happened between 2020, 2022. You come up to 2070 price level, backed off, came back up to 2070 again in March of 2022. So you, again, back up to the high for the second time. And it was the pullback from that March 2022 high that finally got out of control in when? September, October of 2022. And you took out a bunch of prior lows, just like what happened, like you said, in 2008. As soon as you did that, boom, you're back to the highs. So it was a fake out. That was a cleansing drop that was similar to the 2008 debacle. It was over with so fast, if you were on a long vacation, you missed it. Okay. Everybody seems to think we have to have another one. Why? You just had one. Okay. I don't think the stock market is about to crash, by the way. I think the stock market, if it's going to crash, which I think is a possibility in this bear market, it doesn't always occur in bear markets, stock market doesn't always have a crash. .com bubble never had a crash. Okay. It's going to take some months of downside arm wrestling in the stock market before you finally get it to levels that could generate a sharp, rapid sell-off. Between now and then, I'm suspecting you got several months of arm wrestling decline. Now, there's some levels below the market, but they're down there. You're not threatening them right now. So I don't think there's any near-term jeopardy next couple months of anything like a crash in the stock market. Now, you get a little closer to the election, yeah, maybe. So gold, I don't think, is threatened by that phenomenon again. And between now and the next couple of months, I strongly suspect gold's going a lot higher, and silver and miners especially a lot higher. And as you noted, if you go back to the February low of this year, look at the gain that silver's had from that low to the current price, even though there's been a recent pullback. Look at the percent gain in the miners from the February low to where they are now, and look at the percent gain in gold, and you'll find gold is much less gain on a percent basis than those two subcategories. So anyway, I'm not worried about a sharp sell-off in gold. Yes, you're going to have week-to-week drops here and there, but I think we're in the acceleration phase, meaning that part of the bull market where most of the bull market gains of the entire trend at 8-9 years, in this case, we're 8 years old as well, will be compressed in the final year of the move. Most of the drama, most of the percentage. And I think we're at that, we've crossed that line now. I think we're entering the acceleration phase.
In today's market recap, why is the gold rally leaving silver behind? Gold is responding atypically to interest rate expectations, with prices rallying even as the number of expected rate cuts decreased. Slower growth in China and tighter central bank policy may be preventing silver from rallying higher. Normally, gold prices do the opposite of what interest rate expectations do. When bond traders expect more rate cuts, gold typically rallies. When they expect fewer rate cuts or more rate hikes, gold usually falls. In the past couple of months, however, gold has rallied despite Fed funds futures depricing many of the cuts that traders had previously expected for 2024. It appears that one or more large investors has taken a long position in out of the money call options on gold, sometimes with strike prices as high as $3,000 per ounce, perhaps positioning themselves either for large rate cuts that are not currently anticipated by bond traders or for increased geopolitical instability. Silver playing catch up. The fact that the rally has not fully translated to silver may be an indication that either the gold rally is overextended or that silver has substantial catching up to do on the upside. Now we'll show you the best excerpts of the latest interview, but first hit the like button, smash the subscribe button, and share this video with a gold bug. Enjoy the episode.
It's achieved its momentum breakouts measuring its price versus certain long-term averages, like a 36-month average, which is like a 3-year average. It's not the crossing of that average that was so important, but when you plot an oscillator, where you plot the monthly action of silver in its relationship to, let's say, a 3-year average or a 36-month average, you get a different pattern on the chart than you do when you look at the price chart of silver. That broke out just above $25. And we're where? $27.30 or so right now. So we're well above the momentum breakout of silver, the level that says you're re-engaging silver. You're re-engaging to the upside. The 3 years of boredom is over. Okay. The only lagged metric we have now is what we were just talking about, the spread relationship between silver and gold. Just needs a decimal or so more, and that spread will join and say, yep, silver's going to beat gold. And that's basically our final signal. We think there's other things going on in other markets that are influencing this. And, the bond market, stock market, US stock market in particular, we think it's likely topped out of this recent teasing new high that it made due to 5 or 6 stocks primarily. We all know that story. We think that we got a sell signal the first trading day of April that said, okay, that rally is over. We're rejoining the long-term damage that had been done in early 2022 at prices not far below where we are right now, in fact. So I think that teasing rally to a new marginal high in a few select parts of the stock market's over. Now the process is that way. That will no doubt influence data points, which will influence the Fed. And believe me, they're probably eager to start cutting. They're just looking for an excuse. Why? I'm not going to allege political bias on their part, but I've heard from various sources on news programs and so forth that the Fed governors definitely don't want a Trump victory. So they don't want to do anything that would be harmful to Biden. And so, if the economy, if the stock market needs some saving, because that's one of the few things that the current administration could point to and say, look, the stock market's doing good. If all of a sudden that's not the case in the months prior to the election, which we suspect technically will not be the case, then that's going to hurt them. And Trump has already said he's going to fire Powell. So now, again, let's get off that subject. The Fed just needs some data points. Now, we saw one last week, GDP, vastly lower than expected. All you need is like a change in the employment numbers. Now, over the last 3 or 4 months, if you objectively looked at the data that was issued about employment, unemployment, job creation, et cetera, and looked at what components of the job market saw growth in employment. There were government, home health care, hospitality. These were the sectors that grew in job gain. Things like core industrial sectors, core sectors of the economy. Also, government was a big factor in the growth. And this has been true for like 3 months, such that UBS I think it was the head of trading at UBS said a week or two ago, Powell, aren't you reading the data points? Can't you see what's going on here? Why can't you identify that the unemployment numbers really haven't been what they superficially look like? They really aren't good. And Powell's come in and said, oh, it's looking good. Well, what they need, the Fed needs an excuse. And if they can get one like this week, if all of a sudden the job data changes a bit, then that'll be a second piece of data. They got a real problem, though, because they have two mandates. One is to fight, quote, inflation as they narrowly define it, which is like especially commodity price inflation. Our assessment is the Bloomberg Commodity Index is about to be reborn again. That surge in 2020 to 2022 ended. We corrected. We're about to go again on the upside. So that's going to continue to put pressure on them to maintain high rates. If only they could get some unemployment data and some weakened data points like GDP, then they can go to their other mandate, which is the employment issue. So they're really split. They've got a problem. I wish them well.
Is Michael Oliver correct in his call? Will silver rebound around previous resistance, now acting as support, or will we get doom and gloom for precious metals? Post your gold and silver prediction in the comments section down below and watch this video right here because you'll love it. I see you on the other side.